the stock market could be more of a trick than a treat this October. Major averages remain on pace to end the month in the red as bond market volatility and conflict overseas contribute to the market downturn. Our next guest remaining cautious on what lies ahead for stocks heading into the final months of trading. For more, we're joined by Steve Sosnick, Interactive Brokers Chief Strategist. Steve, always a pleasure to get some of your insights and grab some time with you here early morning. So thanks for joining us. First and foremost, walk us through this. I mean, of course, we put the Halloween spin on it, the more trick than treat here. But walk us through your thesis and how you're looking at the last 2 months of this year and what type of activity could permeate over into the beginning of 2024.
Good morning, Brad. The way that I'm looking at it right now is we have, we're in the setup now where this is likely to be, barring something crazy this afternoon, our third straight month where we've seen lower highs and lower lows. That is kind of the definition of a downtrend when you start to see it 3 months in a row. Now, does that mean we're going to plunge from here? Not necessarily, but the setup isn't great. At this point, I think now the onus is for the market is to prove that we've bottomed and can have a lasting rally. Yesterday's jump notwithstanding, we do tend to get very sharp rallies when you're in a bit of a correction or bear market. Actually, we're not in a bear market, but bear market rally. It had that bear market rally tone to it. So right now that's kind of my concern is just the trend is not favorable, and we're starting to see erosion even in some of the Magnificent Seven, which makes me concerned that if the Magnificent Seven shrinks, to a big, to a big six, a big five, whatever you want to start to call it, that's got some interesting dilemmas ahead for the stock market.
Steve, you read my mind. I was literally thinking about the Magnificent Seven, and I want to ask you: is that the safest space within equities as you head through the balance of the year?
Diane, I'm going to have to go with no on that one. I think that, I think at this point you can't look at them as seven stocks together. We'll learn a lot more when Apple comes out, but we saw some very mixed results from them. We saw Alphabet disappoint. We saw Microsoft, do very well. Amazon did well, but they've got an extraordinarily high valuation. Tesla is, I think, at risk of being kicked out of the club right now because they've been really underperforming since their earnings have come out. And Nvidia, we won't hear from them for a couple more weeks, but it could, that chart is kind of almost looking like a Head and Shoulders. I hate to draw Head and Shoulders prematurely, but there are some real risks here, and these stocks are expensive. It's not like you're taking a risk on a stock that's got a very affordable valuation. Based for the most part, you've got these stocks trading with 25, 27 forward PEs. You've got the other 493 trading with around a 16, 17 PE. And that's a big valuation gap. And that's the risk for investors if they just sort of decide that these are the paragons of safety. Some might be, some might not. And we'll learn more as from Apple and later Nvidia.
What is a true paragon of safety, especially in a downtrend like this, as you've kind of looked at and charted this over the past kind of few months here, Steve?
The true paragon of safety is cash at, nearly 5%, right? Quite truthfully. When I think investors need to be thinking of is volatility adjusted returns. Right now, when you can invest basically your money anywhere in the curve and get in the high fours, if not five, with lower volatility, particularly on short-term fixed income like T-bills, like bank accounts, like money market accounts, everything is based off the risk-free rate, and the risk-free rate right now is over 5%. So that's your T-bill rate. And so the question you have to ask yourself is, how much volatility am I willing to endure to do better than that 5%? And that 5%, which we'd always heard there is no alternative, is an alternative. And so that's the competition for equity markets right now. So that's the truly safe space. Now, this doesn't mean just, run to cash and stick it all in T-bills. But what it means is you have to be very selective. And I think I would be looking much more at value stocks than growth stocks, because I think if there is a downtrend, they've already priced in a bit of a downtrend as opposed to some of the high flyers.
Well, Steve, there's always a chatter about, kind of playing too much in individual plays versus index and, passively managed index funds and ETFs outperforming, say, these individual plays. What's your thought or what's your thinking about just kind of taking a more of a passive approach to equity investing then?
There's really nothing wrong with that. The key is a lot of it has to do with our markets moving together or separately. And right now, the problem you have with a lot of the passive indexing is they're very top heavy. And so, you look at the S&P 500, and those seven stocks we've been discussing are about 25% of the index. If you put your money in the Nasdaq 100, that's about 50% of the index. So even passive indexing has its risks to it. For example, today I was looking at the difference between the consumer staples and the consumer discretionary ETFs, and neither has done particularly well this year. But consumer discretionary has outperformed, and the reason for that is it's 40% Amazon and Tesla, 20% of one, 20% of the other, and 60% of everything else. And so this is, so even within your passive indexing, you have to be very careful of the fact that they're not as in some cases, they're not as diversified as you might think they are. And so you have to go into it recognizing that.
All right, we'll have to leave it there. Steve Sosnick, Interactive Brokers Chief Strategist. I think my takeaway is cash is king again. We'll see. Thanks, Steve.